Let's talk about liquidity engineering. Have you ever heard the word liquidity engineering? What does it mean? How does this affect retail traders? It is very important for you to understand this because as a retail trader, if you do not understand what liquidity engineering is, you will always fall into the trap. Have you ever find yourself that you enter a buy, suddenly the market began selling? As you began to sell with them, they started buying again. So they hit you out of the market before when you buy. As you began selling, they hit you out of the market. Has that happened to you before? Now, behind that is what we know as liquidity engineering. Now, if you were able to spotlight this particular liquidity engineering when it was about to happen, you would have been able to save yourself from the calamity of entering the market twice and being kicked out of the market at the same time. So, in this particular video, I'm going to share with you what is liquidity engineering. I'm also going to show you liquidity engineering so that you can spotlight it in the chart before you move on. Now, another word for liquidity engineering is known as inducement, like the word engineering. The word at this context is known as engineering. So, engineering is the act of creating something that possibly was not there, making it to exist. Now, when we talk about liquidity, liquidity refers to the ability that institutions are able to fill their order before an impulsive move happens. So let's assume institutions want to buy Bitcoin worth $500,000. They need someone that is willing to sell. Now, when there is nobody that is willing to sell, they are going to manipulate the market so that retail traders will sell. That is exactly what happened. So retail trader will now be willing to sell, or will now sell whether willingly or unwillingly, knowingly or unknowingly. So whatever it will cost institution to achieve that will be done, and that is where liquidity engineering comes into play. Because what really happened is that institutions will make an act, will create a scene for retail traders to put stops where they wouldn't have put that stop normally. So naturally they wouldn't have put that stop, but because of what institution will create in the market, we retail traders do not have ability to see the back end of the trade. We just see what the chart is showing us. So it's just what we see on the chart that we take. So for that reason, wherever we see at it look okay, this is where the market is related at this point, we'll work with that. Follow me through as I'm going to show you this on this particular chart. If you look at this chart was about going up. But before this particular impulsive move happened, they have to create what we know as liquidity. Now, that act of creating it, that engineering it, is what we are talking about here as liquidity engineering. And as a retail trader, it is very, very important that you are able to spotlight it. So the first thing they did was they created this particular double bottom. Look at this double bottom within this axis. Can you see this double bottom here? Good. Now this particular double bottom here will make retail traders to enter the trade and put their stops below. They'll put their stops just below there. They'll put their stops at this particular purple line. That will be their stops. Let me change the color of this to red. So that will be their stop loss. But notice what happens later. The market moves up as if it's going to go in their favor. From this point, the market moves up as if it's going to go in their favor. Then once it gets there, what happened? The market eventually refuses to continue and come down. It comes to this point that it makes sure that it has kicked them out of their market. It has kicked all the stop losses that were in that place out of the market. So what really happens within this first stop loss here? Let me increase the size of this so that we can see it well. What truly happens with this particular stop loss? Let me make it blue color so that you can see it well. What happened within this blue color? That was a liquidity engineering. Now what did they create in that place? They created a double bottom. Now a double bottom is a reversal trend, a bullish trend signal. So whenever retail traders will discover that there's a double bottom in the market, so the market was relatively bearish, the market was coming down. Now eventually it created a double bottom. This is the confirmation that, oh, I am going to go up, I'm about going up, I'm about to reverse, the market is about to reverse. So that double bottom that they created there is telling them, oh, retail traders, I'm going to go up. So all the chart traders, or those that pattern traders, okay, traders that depends on chart pattern, once they see the double bottom like this, what happens at this particular blue line? They're going to place a buy. They're going to place a buy. They're going to place a buy. As soon as they place that buy, the market comes down to this point. Now, it is very, very important that you understand this so that you can spotlight it on time. Now, why is it so? There's something that you need to know. At least for watching this video, you need to learn this part. An impulsive move will never happen except liquidity is collected. Why? Because institutions are actually buying or selling in a large volume. What truly happens in trading is buying and selling. So if you are willing to buy, there must be someone that is willing to sell. So if institution wants to buy at a large volume, there must be someone that is willing to sell. So when you do not have another party who is willing to sell at that large volume for you, what they are going to do is they are going to manipulate the market so that retail traders will sell for them to buy. Yes, will sell so that they can buy at a cheaper rate. So they are actually going to manipulate the market. So how do they do this? What they do is that they make you and I to put our stops where the stops is not supposed to be, not the actual place. So by the time we put the stops, they will now pull their steps down, come below. So when they come under, they're now proving to the point that, oh, this is where they actually want it to be. So they will come under. When they come under, like where you're seeing it now, they now come below to this sweep liquidity that people put within this red line. Sweep the liquidity out of the market, gather the momentum, and then move forward. So that is what we know as liquidity engineering, the act of manipulating the market for retail traders to put their stops where they're supposed not to put. I hope you're learning something. So an impulsive move will never happen without, you see this move that happens here, it will never happen without them collecting liquidity. So as a retail trader, how do you use this in your advantage? At least for watching this video or watching other video or knowing about liquidity engineering, liquidity manipulation, liquidity deceiving, anyhow you're going to put it. For knowing this, before you enter a trade, before an impulsive move happen, you need to look out for liquidity first. If not, you're going to become liquidity. Another word for liquidity engineering is inducement. You must make sure that inducement has happened in the market and that inducement have been swept out. That liquidity have been swept out. You must make sure that there is liquidity in the market. Like what happened below or above this blue line is liquidity that was created. So as a retail trader, now you see that liquidity have been created. Okay, fine. So the next thing you're going to do is, has it been collected? It must be collected first before the impulsive move happen. Without that liquidity being collected, the impulsive move will never happen. So what you need to look for is make sure that liquidity is collected. If it's not collected, do not enter the trade. Stay out of the trade. Once the liquidity is being collected, you're going to see an impulsive move that will create a fair value gap. Like you can see, after that, you see in this area, we have what is known as a fair value gap at this particular point. So if you notice here, when the impulsive move happened, from this point to this point, created a fair value gap. So with that, you can now wait. What you're waiting for is when the market returns to this fair value gap, you enter the trade and execute the trade. Hope you've gotten value. If you've learned something, kindly subscribe to this channel and stay tuned for more videos, because every week I drop powerful videos on this channel to see that I help you become a profitable trader. So if you know you want to become one, then subscribe and turn on the notification bell. Stay tuned for more videos that is coming up every week.